Welcome, thank you. Just bear with me. The burden of international travel is starting to hit my system, so my voice is a little shaky. But today I want to talk about product strategy that drives real business results. So every product leader, we want to have customer impact, and that should turn into business impact. But when a CFO asks, how does your product strategy show up in the P&L? Often the room can go quiet. Because product strategy and that delivers real business results isn't about what you're shipping, it's not what's in the roadmap, it's those trade-off decisions. It's about what you're choosing not to do, the big bets that you are doing with conviction and the courage to say no when something looks good or the customers are asking for it, but it doesn't actually move the needle. So I'm Felicity Harding. You can hear from my voice. I'm from Australia. I work at Canva. I lead the brand experience product group. And together with my teams, we deliver 40% year-on-year growth by connecting our product strategies to customer acquisition, customer retention, and customer expansion. So before Canva, I've delivered product strategy and growth for companies like Booking.com, and my very earliest career started as a product manager at Disney, where I worked in the DVD business and introduced streaming services, which feels very similar to what we're seeing today, having to be a product manager for a traditional business and then have introduction of new innovation and technology and trying to manage that profitability and introduction of two new revenue streams that are actually potential to cannibalise. So it's really interesting to see how that's playing out now. So this talk, as Simonetta introduced, is about revenue generation and connecting our product leadership to how the business earns money. And I've seen the same truth everywhere. It really is about the decisions that you make and the decisions you choose not to do in terms of how you're going to drive revenue and how it shows up. So I'm going to share tools like driver trees, the revenue flywheel, segmentation, ROI sizing and data opportunity sizing to show how the product decisions can actually connect to the P&L. And I'm going to bring this to life by sharing a couple of different short stories based on my experience that shows different contexts for each of these tools. And I'm going to start with a story about cancellations. So cancellations is something I'm sure many of you can relate to. I was working at a large online marketplace. So for the purposes of today, let's say that they're a hat seller, but it won't be too hard for you to connect which product, in my experience, this was. And so the industry cancellation rate was anywhere between 20 and 50%. And ours was on the higher side and it was rising. It wasn't good. So cancellations means lost revenue, but it also means so much more. There's a hidden cost to cancellations. So when I cancel my sale, the inventory can get lost. It doesn't automatically go back into the marketplace to be sold to a new customer. So there's a double dip loss in revenue. It also means customer friction for the user that's cancelling, and it means our sellers are actually having a bad time because they thought they had a sale and their revenue is lost as well. So the metric and our customers said we had a cancellation issue. But actually that was wrong, sort of. Because when we dug into the data, we could say that not every customer was actually cancelling. There was a really interesting behavioural insight that we uncovered, which was they were cancelling and then rebuying. So zooming out, we saw that they still wanted to buy from us, just they didn't want to keep the product they'd already bought. So instead of having a blue hat, they actually wanted a pink hat. And so we were forcing them to cancel and rebuy. It wasn't good business sense, and it was definitely not a good customer experience. So we thought, what if we could avoid this costly segment of cancellations? And what we did wasn't just fix a metric, we actually flipped the funnel. We connected the cancel and rebuy insight to a monetization play. By turning our cancellation flow into a conversion flow, it made it easier to switch products, and it also automatically put that inventory back in the system to be resold to a different customer. So it wasn't just a revenue win, it was also an experience win. And the same customers, the same funnel, but now the money is staying in the system. It was a really powerful insight. So cancellations became product switches. We reclaimed lost sales. We resold inventory. We actually increased the revenue per sale too. So every switch actually turned out to add about 10% more revenue. And of course, it was happier customers and happier sellers. So revenue generation isn't just about getting new customers, it's also about finding hidden value in the customers that you already have. So how did we uncover this insight? By following the money. To do this, I used a driver tree to map the flow of money, and we uncovered what was really driving cancellations. So think of a driver tree as a blueprint for how your product decisions show up in the P&L. When you unpack it with a driver tree, you can see the cause and effect between branches like sales or onboarding or cancellations. So for our cancellation case, we started at the very top, which is the business outcome, which was commission. And then we worked our way and mapped the branches of the tree. So once we'd mapped all of the flows, then we went back and added the numbers so we could actually see where the biggest impact was. And that's how we spotted patterns like customers cancelling because they wanted a different style or a different colour, or they wanted to change the delivery date. And so while I can't share that exact driver tree from that project, I've rebuilt a really simple one using a ticketed event like we're at today to bring it to life for you. So at the top is the main business metric, which would be profit. And then the branch breaks down into the drivers that influence it. So profit is an outcome of revenue less cost. And you can see that the revenue is an outcome of things like ticket sales plus sponsorship plus anything that's sold on the day like food or merchandise. And so you keep breaking it down until you actually get to the branches where your team metrics appear. And that's where they can see how they can influence the P&L and how it maps back to their actions every day, connecting to a business outcome. But just because you know what drives the business outcome doesn't mean you know how to sustain it. So with the driver tree, you can see the impact. So using the driver tree to see the impact of aligning monetization and product strategies, we can see that for events, it's a one-day business, right? You've got one shot to make all your money. And so this is where your monetization play and your pricing can really come into play and can really affect the business success. So if I run a 30% off early bird promotion, I will actually be delivering less business value. So you can see at the top, it's a fixed cost. It still would cost me $50 per person to put on the event. That doesn't change based on my ticket price. If I just have an early bird ticket, which is 30% off, I might be high-fiving myself because I'm going to sell so many more tickets. But if I sell 1,000 tickets at 70, I'm actually going to be making less profit than if I sell the general ticket price. And so, again, product teams might be celebrating the win of a big number and the customer impact there, but the CFO might be thinking that this is bad revenue or bad growth, sorry. And so I'm going to completely show my age here. As I said, I worked in DVDs, so if any of you remembers DVD rentals, you would go in, you'd choose your DVD on the Friday night, you'd promise to bring it back on the Sunday, and then you'd completely forget about it. So you'd go back in a week later, you get hit with a late fee, and it can often cost more than the movie itself. And that was amazing revenue for the rental store, but actually it was bad revenue because it was based off customer friction. And so then, they were having a great time until Netflix came along and actually built a model around the exact opposite of ease and trust and customer delight. So if your revenue model is based around friction, you're really only one innovation away from being challenged by your competitors. So how do we actually build revenue that's based on customer success and not customer failure? Once you map the business with a driver tree, you can see where the revenue's coming from. So price, conversion, retention, whatever the branches are that you're looking through. But like I said, it doesn't mean just because you know where the revenue's coming from, you know how to sustain it. That's where this revenue flywheel comes in. So every stage of the flywheel, acquire, activate, monetize, expand, retain, refer, builds on the one before it. Now, most teams think of revenue as a moment, but it's not when you look at it in this lens, it's really a motion. So in an event world, this still holds true. You buy the ticket, you come along, you have an amazing time, you're talking about it online, you're telling your friends about it, and you come next year and you bring your team as well. And that's compounding revenue. Yeah, it starts a bit slower at first, but actually it accelerates with every cycle, and it's built on trust, consistency, and delight. And when that's really aligned, you stop forcing growth, and customers want to come back and they'll bring their friends too. So I touched on the importance of time to an event, that makes sense, but it's also applicable to other businesses. And I saw this play out firsthand about the time value of revenue and matching your business rhythm with your customer rhythm when I was working for a payroll solutions company. So it's a subscription business with value-based pricing and annual renewals. And the business rhythm wasn't driven by marketing campaigns or our sales quotas and incentives. It was defined by compliance cycles. So government reporting, end-of-year submissions, and processing. That meant timing wasn't just operational, it was actually business critical. And every product release and every customer communication had to respect that rhythm. If you miss that window, it costs you more than just goodwill. It actually can create business risk for your customers. Now, most renewals happened right around the time of those compliance events, which meant the customer's perception of value had to happen long before the actual renewal event. And so we had to shape how well we'd supported them up until that moment. So I mapped our release cycles and our customer communications around that rhythm. We shipped key features well ahead of their renewals, so customers experienced value before it mattered most. And we avoided releases in what we called blackout periods, those times of peak compliance activity where they just needed stability. And the result is customers realised the value of the subscription more often, renewals became much easier, and expansion conversations opened up naturally. So we know that timing affects the revenue flywheel and how quickly value shows up in the P&L. And we also know that numbers don't always speak for themselves, like having a conversion problem hidden inside cancellations. You can have the right result and still tell the wrong story. That's where storytelling comes in, how we frame what the data actually means. And I'll give you an example. We were reviewing a feature and the numbers looked bad. There was about 3% usage and triggered all the usual questions. Have we built the right thing? Are we building something that's too niche? Should we pull back investment? Now, the data actually wasn't bad, but the story was. So we dug deeper, and segmentation changed everything. We defined and sized the total addressable market, the SAM, and our target market, whose pain points we'd been focused on solving. And we saw that it wasn't failure, it was early traction with the right audience. So we'd been telling a story of scale. It was 3% use across all users. But actually, it was a story of beginnings, and they had a 25 times higher usage rate. Our target market loved us, and they actually had the highest revenue and retention. Quite a different story. So what did we do? Well, we did a couple of things. We built a phased roadmap around those segments, using insights from customer calls, social sentiment, our own product discovery. We prioritised work that made us indispensable to our target audience, and then we expanded out from there. And we also reframed the story for our stakeholders. So we told a great money story, we used the actual data, and suddenly we had finance, sales, marketing, and product all telling the same story. Early traction, valuable customers, a clear path to expansion, and scalable growth. And it helped us avoid the pressure to pivot the team to high impact work, which raises the question, what sort of impact or return should you expect from a product team? And that's where ROI comes in. It's not a spreadsheet exercise, but a real clarity exercise. And I look at two types. The first I look at is team ROI. So how well are we converting effort into opportunity? So for me, in my business context, a healthy benchmark is a 5 to 7 times return on the investment for every team. So you might not know the actual cost of your team, and you don't need to. For me, in the past, I've used as a proxy a really lovely round figure of $1 million per team per year. So if you're spending $1 million on a product team every year, I would expect a 5 to 7 million incremental return on investment for every team. So for every dollar that we spend, $5 to $7 of impact is returned to the business. So when you can show that kind of team ROI, something shifts and you start being seen as not as a cost centre, but really as a value driver to the business, and you can take bigger bets. Now, you might think that that's not within the team's control. It absolutely is when you have the right inputs. And the inputs will help them make the trade-offs. So to do this, there's typically 3 questions that I would ask. Is the juice worth the squeeze? Is a great question. Is the time, the energy, and the focus of that team going to deliver the revenue impact? When we consider all the options on the table, and truly, I think one of the hardest things in product is actually what you choose not to do. So when you consider all of the options, are we focused on the most highest impact revenue opportunities? And third, do we know what success looks like? If we know what success looks like, we know if we're approaching it or how far away we are from achieving success. And that helps us know if we need to double down, if we need to pivot, or if we need to pause investment. Now, thinking about product ROI, the dream state for me is one clear number that the CFO already cares about. For example, every 1% increase in usage delivers $7.5 million in incremental revenue. And why I love this type of number so much, this unit metric, is something that everyone can rally around because it shows a team level metric like usage So you can have your designers, your engineers, your delivery teams, and the team watching this every day, but you also very clearly connect it to the business outcome. So how do we get there? Well, through data analysis and opportunity sizing. It's how we quantify the hunch. It's how we know how big the problem is and if it's worth it. And Rich will be taking us through some of this in more detail later on. So by this point, we've mapped all the inputs. We've looked at revenue, timing, segmentation. These are signals of how your product connects to the business. But great product leadership is not just connecting dots to a dashboard. It's about turning those inputs and the stories of our customers into strategy that builds a business today and creates momentum for tomorrow. Because every number in the P&L represents a human behaviour, a decision for them to try, to buy, a decision to stay, or a decision to leave. And so the skill is knowing when to continue, when to stop, and when to do this in rhythm with your customers. And that's when a roadmap will move the business. When you can align the business rhythm with your customer's rhythm and the story of growth with the story of the customer value, it's when strategy turns into the movement, and that's great product leadership. So how do we make this real? Here's the recap of my go-to tools to help teams listen, size, and decide with the customer in mind, to connect what we build with what the business earns. So each one is a storytelling tool that takes us from metrics to meaning. So driver trees and the revenue flywheel. This is how we design growth that moves and multiplies. Driver trees map the levers like price, conversion, retention, and show how they connect to revenue and profit, and how our customer actions turn into business results. The revenue flywheel brings those levers to life, showing how each turn builds momentum for the next. And together, they help us design growth that customers truly want to sustain. Segmentation, this is how we focus. It turns growth from a generic ambition into a scalable strategy. And ROI, it's not just a spreadsheet exercise, it's a clarity exercise. It helps us decide what's worth doing. Data sizing shows the estimated impact of the opportunity, and ROI shows how efficiently we capture it. And together they turn impact into alignment, and alignment into growth, and it keeps our big bets honest. So these tools help you build strategies that directly generate revenue. And as we head into the track, you'll hear how this connects to the other side of the profit equation, which is cost efficiency and optimization. Because growing the top line and protecting the bottom line is two sides of the same story. So as you go back to your own product teams, I will leave you with the question, does your roadmap move the revenue, or does it just move the metric? Because when you can answer that with confidence, that's when you stop managing features and start truly leading the business. And product leadership then is not about what you ship, but it's about what you shift. Thank you.